So having hopped across, our next thought leadership session is with B2C2. And unlike the others, this is actually live. So I'm delighted to be to welcome probably the person who got up the second earliest after myself, because Phil Gillespie, co-CEO of B2C2, is based in Tokyo. So a very early good morning to you, Phil. I wanted to talk to you about, it's quite strange, yeah, we both have backgrounds in sort of, those fiat markets and FX markets. But a debate a few years ago was OTC versus exchange. And in our previous panel on crypto market structure, we did have a question come in, which I deliberately held for you, around how we see OTC versus exchange play out in the crypto asset world. What's your view on it?
Right. Yeah, I think it's really important to first understand, to understand where we are now, we need to kind of understand how we got here, right? And then we can answer where we're going. So if we look at the last 10 years, crypto started peer-to-peer. There's really no custody solution outside of exchanges. So really, crypto exchanges was the only place where people could buy and sell and hold their coins. And that was the case for, I think, for the first 6-7 years. So from 2009 until like 2016, it was just all about the exchanges. And then from 2017 onwards, you started kind of seeing these OTC liquidity providers like ourselves pop up. And gradually the market started to change because, there's this thing, right? If we think that crypto is going to be mainstream, and let's ask ourselves that, do we think that mainstream means people are still going to be buying coins on exchanges, or you'll be buying it at, say, your local brokerage where you trade your equity, FX, everything else? I think it's the latter. And if it's the latter, it means that OTC needs to grow. And what's really happened from 2017 is that, third-party custody providers started to come out. All of these infrastructures started getting built out. So now we're seeing this massive transition from exchange-driven to OTC-driven because the market is getting a little bit more mainstream. Actually, it's not a little bit more, it's getting extremely, more mainstream, right? You have, the participants are changing from pure retail to hedge funds and to, some tier 2, tier 3 banks, to family offices. And for these guys, they need consistent liquidity. They need that OTC type, FX type market structure in order to trade. So that's kind of where we are. We're in the midst of this transition. And if I think about where we're going in the next 5 to 10 years, so I think there's over 480 crypto exchanges at the moment. So I think we've kind of, overdone the, the crypto exchange side. And if you think about the evolution of the market, I really think now you're going to see some consolidation and perhaps even institutional only exchanges starting to form. And given, Colin, you and I are both FX background, I think we ultimately know that, the ratio of OTC to exchange is going to be quite, shifting in the next few years. So in 5 years from now, I think there's going to be primary exchanges, for institutions, maybe a few primary exchanges for retail, and then OTC in between.
Yeah, because I guess what we're talking about here really is that very important risk warehousing or risk absorption role that the OTC providers offer.
Correct. And that's the thing, let's say an investment bank or a hedge fund comes in, they need consistent liquidity. They can't, really engage in a market where if there's a market dislocation, like we just had with Omicron headline, if they need to get out of risk and they need to trade $100 million worth of Bitcoin or any other altcoins, they need that liquidity, right? They can't rely on an exchange with fragmented liquidity. And market makers, as you know, are quite opportunistic on exchanges. So you need the OTC side, which, you're providing a service and you need to show that bid or offer. So it's natural for people to want and for the OTC side to develop.
Yeah. How does the credit side of that play out, though? Because obviously there is a challenge there with, some of the investment banks out there facing off.
Yeah. The entire ecosystem is evolving. So I think we're one of the only crypto firm that got acquired by a actual listed company and a financial institution. So we're acquired by SBI, who already has pre-existing relationship with a lot of these banks, right?
Right.
So, I understand from, even though, I like to think that we're getting big and, we're doing, pretty well. Still from the serious large players, there's a credit aspect, like you mentioned, the counterparty aspect. And for those right now, we can facilitate trades through our parent company in SBI. Ultimately, there needs to be some kind of a PB solution or some other kind of solution that really comes into play. Again, these developments are happening so fast, right? I've been doing this for 3 or 4 years, and every year the structure is coming into place. But for now, we're kind of using our kind of a parent company to facilitate these kind of large trades.
Yeah, because one thing that strikes me, and you're in the perfect position to sort of confirm or deny this, but it does seem to me that there is demand now for larger trades. Yeah, the demand for larger trades is growing.
Oh, 100%. And so to put some kind of understanding around liquidity, I remember when I started in 2018, in 2017, if you look at the trades, if there's a $5 million, $10 million trades, $5 million notional trade, it used to be a good side trade because we might be doing a few $100 million ADV at the time. Now we're doing billions of dollars of trades every day. So really, if a client comes in and says they want to do $100 million execution, it's just not that big of a deal. And we have some kind of a forecast model on where we think the market's going in terms of spread compression and everything. And I basically took kind of like the EM market, EMFX, back in the 90s, right? Highly correlated, wide spreads, is kind of moving around, and kind of accelerated that transition from like the late 90s to now in like 5 years. That's kind of like the understanding of the liquidity, spread compression, everything, right? And we might be right. That's probably how fast we're evolving because, 3 years ago, again, 5 million was a lot. Now, 100 million is just not much. So.
Yeah, and I guess because I guess we're looking at if the correlation or the comparison with EMFX is actually a good one because this kind of makes this a second generation evolution, doesn't it? And they tend to happen a lot quicker than the first generation. So. Yeah, do you see spread compression becoming? Do you actually see more traditional FX challenges coming into the crypto space in the next couple of years?
Oh, 100%. And it might be interesting, especially, maybe it's just us because we're from FX background, but I really like the EMFX comparison because I think it's fair to say, 20, 30 years ago, the correlation between all the currencies are pretty similar. And then now, you see what's happening in Turkish lira versus maybe South African rand, and other places, and the coins are moving separately. And I think that divergence in the correlation is going to start to happen as well. And, so it's not just about the spread compression. It's also, you're going to be able to start to diversify your kind of holdings and, your portfolio within the crypto ecosystem. That's something that hasn't really happened, right? Right now, most of the guys are just trading Bitcoin, Ether, and everything else is highly correlated to the two. And I think that's going to change. And I think with that, you're going to start seeing these massive spread compression and liquidity changes. And ultimately, another thing that's very important. So we only engage in like the top 15 coins. A lot of firms will say we do all of it. And I really think this is the part that we need to be careful because unlike EMFX, a lot of these coins might not be around in the next 5 years. So we're very careful. We look at, market cap, we look at liquidity, we look at the availability of the coins before we decide to list them on the OTC side. But for those that's going to survive, I think, the liquidity is going to continue to build and spread compression is definitely going to be an issue just like in FX.
Yeah.
Very fast.
Yeah, and I think that's the thing, isn't it? It could probably happen faster due to the experience. I guess the other area I'd like to talk to you about while we've got time is the impact of regulation. Regulation is kind of changing the landscape in FX, but it's very, very slow. But in crypto, how do you see regulation changing the landscape in the crypto asset world?
So, I'm in Japan, and it's really interesting because I see the regulatory changes happening east to west. And it's fair to say countries like Japan, Korea, Singapore were the first to start putting some kind of a framework, regulatory framework around crypto. And now we have, the FCA in the UK and in Europe, and now ultimately the United States. So we're having this transition. What I noticed the regulators focused on is that they're really focused on protecting the retail side. We're having a hard time explaining, just like I explained the transition from exchange to OTC. They don't necessarily understand that transition. So they're very focused on the exchange. They're very focused on retail. So some of the stuff that I see them doing is they want to cap the leverage because they understand naturally that high leverage equals higher chances of market volatility. So that's actually being implemented in 2018. Say for Japan, for example, again, because these changes are happening and a lot of regulators are copying what's happened before. The leverage was 100 times. Now it's capped at 2 times. Wow, talk about leverage compression. And I think ultimately it's also maybe there's a little bit too extreme, but it does lead to less kind of speculative trading and huge amount of risk being thrown around and people getting washed out, and then the market kind of just completely moving around. So I think the implications of regulators really setting the standards is that the market starts to act more orderly, and ultimately once the rules are set, it allows for institutions to say, okay, these are the rules in which we can engage in crypto. Now we can start a business around it. So a lot of people, say like, oh, what's the use case? Or, how come these companies are still not operating in crypto in certain jurisdiction? Well, the rules needs to be in place. And that's what the regulators are helping to do.
Yeah. So what role do you see the investment banks playing in this world going forward? I mean, is it going to be something, like the B2C2 structure where you have the balance sheet strength of the parent company, but you are the specialist crypto section, or do you think they'll just try and make it part of their broader business?
Well, there's 2 phases, I think. I think in general, all the banks would be interested in, having another revenue stream. I would as well in any business, right? It's nice to add. At the moment, I don't think it's possible for, investment banks to just come in and say, okay, we're going to do crypto full on. So it has to be in the form of derivatives. Because when you start talking about physical coins, it's not just the custody, it's also the transaction monitoring, it's also the reporting. There's a lot of stuff that gets involved. I mean, let's think about that. We're having to deal with that ourselves. When you hand a $100 bill, you know who you got it from. But when you see a coin, you see the whole, the whole history. And where's your responsibility? And all of these things, again, are not clear. So the banks can't really touch it. That's the truth. So I think the derivatives is where they're going to start. And in terms of the role they're going to play, there's a lot of guys who want crypto exposures, a lot of hedge funds and other counterparts. And they can't face guys like us. They cannot face, even SPI. They cannot face the exchanges. They can only face the tier 1 banks. Yeah. So I think with, for that subset of clients, they're going to be able to provide NDFs, options, these kind of liquidity, structured notes. And once institutional exchanges get built out and there's a proper framework around all the reporting and the monitoring and custody solutions laid out, that's phase 2, which I think will take over 5 years. Then the investment banks are going to be very much involved, just like we see in FX. But that transition is going to take quite a bit of time. And I don't think people understand it's not just about custody. There's a lot of components here that makes it very tricky for banks to just go all in.
Is it a question that once they've actually got the framework in place around this regulatory and all these requirements they have, then it becomes a lot easier? So we'll probably see a slow development followed by a burst of activity as everyone can suddenly get through the door?
Yeah, I mean, I think there's, 5 or 6 different components that needs to be sorted, and they're all kind of slowly moving. And, once you kind of start hitting, start resolving one of the other, the PV, custody, the regulatory framework and stuff, then surely, banks would be able to come in, because a lot of the liquidity provision and everything else is very much what we used to do in TradFi, right? It's a bit of a combination, I think, of FX equity and commodity, but ultimately, I mean, this is bread and butter for the banks. So.
Yeah. One final thing then, Phil, before we have to go. Stable coins. What role, I mean, how big a role are they going to play?
So it's an interesting topic, and it's a big one that you've left for the last question.
As always.
Yeah. So I think, again, it's kind of similar in my view to the transition of like this, this kind of the historical transition that we've seen in exchanges, right? You see like the likes of Tether still around, and it's quite important to the ecosystem. Is it going to be around for the next 5 to 10 years? Hard to say. There's USDC, which is becoming more and more important to the system as well. But the thing that we're not really talking about, and this is a huge topic itself, is CBDCs. Yeah. So, once you start having the digital yuan and so on come into play as well, stablecoin is going to be a huge factor. So let me focus on one question that, on someone who's watching this might have is, once CBDC comes, isn't that the end for, say, Bitcoin, right? That's an argument that I hear sometimes. Say, okay, once a stable coin dominates, why would anybody trade any other crypto? Well, take the digital yuan, for example. A lot of the CBDCs are kind of a local solution, right? I don't know how much time I have, but like say for example, COVID is an interesting thing where you need to, give money to your citizens and so on, and you need to track the usage, and you need to, you want to do these things as a government. CBDCs are basically what, it's built and it's going to be controlled for those purposes. You have an emergency measure. We say, okay, well, let's link it to the Social Security or some kind of citizenship number, distribute it to a digital ledger. Let's, cap the use so that people just don't go straight to the casinos. Let's make sure we help out the restaurants and so on and so on. Well, whitelist the use. From a bureaucratic sense, that's great. And I think that's why a lot of countries are looking at, especially because of COVID, they said, okay, we need a better solution than sending out checks or, not knowing what people are using their money for. So when you have these local usage, you're going to start seeing applications, and you're going to start seeing more acceptance of these kinds of, digital tokens. So that's good for the overall crypto ecosystem. Now, what does it mean for Bitcoin? Well, Bitcoin and Ethereum, these are not bound by any national borders. There's tax implications, but in terms of the usage, it's a global thing, right? So serving a completely different purpose. So stablecoin is very important. We're going to see massive development in terms of CBDCs. That is going to ultimately, I think, help crypto because it just adds more to being able to use it more freely on your phone or some kind of other mobile devices, and ultimately crypto will serve kind of like the overall ecosystem. CBDC is the local ecosystem. Yeah, that's my view. Yeah.
As always, Phil, great to talk to you. Thanks for getting up early.
This is exactly the type of stuff I want to talk about at 4 a.m. So
yeah, I feel your pain. Thanks very much, Phil. Appreciate your time on B2C2 support of this, and I'll talk to you again very soon.
Great. Thank you very much.
Yes.
Bye.